Today, I'm gonna walk you through a small business retirement plan that's gonna go from zero to over $9.3 million using 4 different types of retirement accounts. Now, this is a pretty simple strategy, but clearly it's very effective if we can go from zero to $9.3 million. And this is something that I use all the time, and I use it for my personal situation in the way that I save. So I'm gonna walk you through the entire plan, just focusing on the retirement aspects to it. So we can figure out how we can save even more, how we're making these contributions, what plans we're gonna use, and how you're gonna break up your income when it comes to an S corporation. So let me go ahead and start with the base facts. So this is a married couple and they have an S corporation and they're 36 years old. They want to retire when they're 60, but they have nothing saved right now. Now, right now, this S corporation has $200,000 in income and each spouse works for the company and they're each drawing a $50,000 W-2 salary. Now, the remaining amount is going to come as a distribution. Now, if you're not familiar with the types of income for an S corporation, W-2 is just like a paycheck. The distribution, the reason that you want distribution dollars is because it avoids the self-employment tax, or also known as FICA. So in this case, it's FICA for an S corporation. That is Social Security and Medicare. Now, this is not earned income, so you cannot make the contributions from these dollars, but you can from these dollars. Another thing that you want to pay attention to when you're deciding how much you're going to pay yourself, not just for retirement plans, but also something that's called a reasonable wage. You have to pay yourself a reasonable wage or the IRS will audit you. If they audit you and they think that you're lowballing this number, that's not to your industry standard, they'll actually take all of the income and make it all W-2 income. So you're gonna pay the FICA taxes on all of it if you mess this one up. So make sure that you have some documentation and that you make sure that it is a reasonable wage. Now, I do have another video on that, so go ahead and watch that and I give you some more details on how to figure out what your reasonable wage should be. But right now, we have 2 income earners at $50,000 each. So that's what we're starting with. Now, let me talk about the types of retirement plans. And this is not complicated. This is actually fairly simple to set up. And this is a board I used the other day, but it still has all the 4 accounts that we're going to use. So we have the traditional IRA, we have the Roth IRA, we have the traditional 401k and the Roth 401k. Now, this small business owner doesn't have any full-time employees, so we're going to use a solo 401k. So you can still have your traditional 401k and your your Roth 401k as a part of the solo 401k for both you and your spouse. So even though the spouse is a part of this plan and a part of the company, and there's 2 people that work for the company, they're both married filing jointly, so they can both have a solo 401k. Now, if they had a full-time employee, you couldn't use a solo 401k, but in this instance, they can. So these are the 4 types of accounts that we're going to use. Now, first, I'm going to show you what we're going to set up here. And here is our financial planning tool that I'm going to help illustrate what we're going to go through. And we're going to make contributions into the solo 401k, which is the qualified retirement plan here. We're going to do it again for the spouse, and then we're going to make contributions to the IRAs. Now, as far as the difference between the traditional and the Roth goes, I don't need to illustrate those because if we're doing things like backdoor Roth conversions, which we can do, the numbers are going to be exactly the same because we're going to take the money from the traditional side and roll it over to the Roth side in some instances. And in doing so, we want to pay the taxes with outside money. So I'm going to assume through this plan that we're paying these taxes with these distributions. So this is the money that we're going to pay those taxes with. So that way we can get the maximum amount inside of the retirement plans, but we're not going to focus on that part. I'm just going to show you how to get the money into the plan. So here's how it's going to break down. If we look at the qualified retirement plan, the solo 401k, what we're going to have here is a $50,000 W-2 income to deal with. So here's how we can maximize the amount that goes into these retirement plans. Now for 2022, we can put up to $61,000, but it's going to be limited by our compensation of $50,000. So we can break this up by making a $20,500 pre-tax contribution. Now, if you're familiar with a 401k, this is exactly the same number that you can do for 2022. It's $20,500. For 2021, it was $19,500. So this is what we can do for 2022 as a pre-tax contribution. Now you can split this up any way that you want. If you want to put it onto the traditional side, you can, or if you want to put it onto the Roth side of your solo 401k, you can. I just choose to put it into the pre-tax side. I'll explain why in just a second. So then we can do a profit sharing contribution. And the profit sharing contribution will work out for an S corporation to be 25% of the W-2 compensation. So in this case, it's going to be $12,500 as a profit sharing contribution. The third contribution is going to be a non-deductible contribution, and this is going to be $17,000. The reason I chose $17,000 is because we already put in $20,500, and then we already put in $12,500. So $20,500 plus $20,500 plus $12,500 is $33,000. And that means $33,000 to $50,000 is $17,000. Now we can do this as a non-deductible contribution, and that is the mega backdoor Roth conversion. So we can put it in as a non-deductible contribution and then immediately convert it. There is a benefit to doing this. The benefit to do it in a solo 401k versus your IRA is that we don't have to worry about the pro rata rule. So what we can do is make that non-deductible contribution to the traditional 401k and then immediately convert it to the Roth side and not have to pull in any other dollars. Now, again, one of these technical terms, pro rata rule, if you're not familiar with it, I do have other videos, so go watch those to get a little bit more idea of how the pro rata rule works. But that is one of the benefits of the solo 401k versus your IRAs for the backdoor strategy. Now, in addition to all of this, we can go in and we can make a non-deductible contribution to our traditional IRA and then do the same thing and immediately convert it over to the Roth side. Now, in doing this, that means we're never going to have any money in our traditional IRA because then we'd be subject to the pro rata rule if we did. Now, in this case, we don't have anything saved. But if you did have something saved, then the other strategy you can also use is taking the existing dollars in your IRAs and rolling them into the traditional 401k to, again, avoid the pro rata rule with the traditional IRA. So if you had a balance, say, of $50,000 day one, I would take that $50,000 and I would put it into my traditional 401k or my solo 401k. And then I can make the non-deductible contributions every year and immediately convert it to the Roth and not have any issue. Now, if you're below the thresholds, then you would have the ability to potentially put it into the traditional IRA, but that's not likely because your income needs to be significantly lower in order to make those types of contributions. So in this case, that wouldn't work. You would have to make a non-deductible contribution into the traditional IRA, or you could potentially make it directly into the Roth IRA. Now, this is going to be dependent on your adjusted gross income. So I'm just going to explain going into using a backdoor Roth strategy. But like I said, it's not going to change the numbers. If I make a $6,000 contribution into my traditional IRA and then convert it, well, the conversion, because it's a non-deductible contribution, I'm not going to pay any taxes. So in doing the conversion, there's no taxes. So it's still $6,000 that gets contributed to the Roth IRA. So that's something just to think about as you're doing this. So I will quickly bring up on the screen the maximum contributions that you can put in. So for 2022, like I said, you can make a $20,500 pre-tax or post-tax contribution to the Roth side. Either one, it just can't be over $20,500. And that total amount can go up to $61,000. However, our W-2s are only $50,000. So the $50,000 is the maximum that we can make as a contribution. Now, if we look at the Roth maximum income limits, you can see that it's $204,000 to $214,000 for married filing jointly for 2022. So in this instance, we could make the contribution directly to the Roth side. However, I still wanted to show you the non-deductible contribution to the traditional side and then roll it over. Again, it's not going to change any of these numbers. I'm just pointing out what you could potentially do. So let me go ahead and now flip into the plan to show you how this all stacks up. So if I pull this up for you, we could take a look at our plan right here. Now I'll break out each one of these numbers. Both of these plans are going to be the same. The contributions to the solo 401k and both of the contributions to the IRAs are going to be identical. So the first solo 401k that we'll take a look at is going to have a contribution of $50,000. And again, that's going to be broken down by the three types of contributions that we have with the pre-tax, the profit sharing, and the non-deductible contribution. Now, there's always a lot of different ways that we can mix this up depending on which side we want to put it on or how we want to do it. This is just one way of doing it. So that would equal $50,000. And if we're assuming an 8% rate of return every single year, all the way from age 36 up until age 60, that would equal over $3.5 million. Now, I always point this out in these videos. That says age 59 in the year 2045, but that's at the end of age 59. So really on your 60th birthday in this plan. So it's over $3.5 million in that single solo 401k. Again, it could be broken up between the traditional and the Roth, almost any way that you want to do it. Now, if we add that second solo 401k, so we have both spouses making these contributions. So instead of $50,000, we're going to have $100,000. And as we grow that money, it's going to be over $8.5 million when we're age 60. Now, if we throw in the IRAs, we could see that those contributions will be $6,000, and that jumps it to over $9.3 million. Now, really quickly, to show you the impact of just one of those IRAs, if we take a look at that, making those $6,000 contributions from age 36 to age 60, that's going to be over $400,000, and that is going to be in each of these IRAs. So it's not just a small amount. Over time, it really does grow to over $800,000. So there's a ton of money in these retirement plans, and they went from zero to this amount in this time frame from age 36 till age 60. So $9.3 million. So now let me go ahead and tie this all together so I can show you how this works, because there's a little bit of pre-planning that you're going to need to do. So if we're looking at the W-2 income, this $50,000, you might think this is income, this is what I'm going to live on. It's not. This is the amount that we're going to save. So if we wanted to save, say, $61,000, which is the maximum that you can put into your solo 401k, we would have to have pre-planned to get this number up, because you can't pay yourself a W-2 wage retroactively. Now, the distributions is what we're going to live on. So we're actually going to live on even less than the $100,000, because we're also making those traditional IRA as non-deductible contributions to our IRAs. So that is what we need to pay attention to find that balance. And obviously, in addition, that I just said before, that this $50,000 has to also be a reasonable wage. So if you wanted to save $20,000, but that's not a reasonable wage, then you're stuck with a higher amount, because it has to be a reasonable wage. In addition to that, the types of contributions also have a little bit of pre-planning. So I talked about before that we had these three types of contributions. Well, this employee contribution, which was our $20,500 pre-tax contribution, it could also be a Roth side contribution. We just did it as a pre-tax contribution. But that contribution has to be run with payroll. So that has to be done throughout the course of the year. Now, these contributions, your profit sharing and your non-deductible backdoor Roth conversion strategies, these can actually be done up until your tax filing deadline, including extensions. So the including extensions for an S corporation is up until September the 15th. And if you're Schedule C, that can go out until October the 15th. But those contributions are what they're referring to as we can open and fund the solo 401k, which is the same as the SEP IRA. So a little bit of pre-planning there that we need to take a look at. Now, the last thing that I want to show you is the actual impact in today's dollars on this whole retirement plan. And what I wanted to show you here is taking this $9.3 million and just quickly showing you what it's worth in today's dollars. So that present value is $5.1 million. So even though 9.3 in actual dollars, in real dollars at 5.1 million, still a chunk of change to recreate your income stream. In addition to all of this, what we're doing here is lowering our expenses to maximize our savings. And in doing so, because we're getting used to spending less today, it's only going to make it easier in retirement when we have a huge nest egg, but we're used to spending less. So there's a lot of benefits to making sure that you're finding balance in your total financial life between your savings and your spending that will carry on all through retirement, including today. So that is even more pre-planning, that you need to figure out how to find that balance and how to reduce some of those extra expenses that you might have that might make it impossible or very difficult in order to save this amount. But starting at age 36 at zero and retiring at age 60 with $9.3 million isn't that bad. I hope you've enjoyed this video. Be sure to subscribe, and we'll see you on the next one.